I'd say over the last 9 months, the word affordability has become sort of the key political term. And Zoran Mamdani became the New York City mayor, running solely focused on affordability issues. And affordability is a huge issue in New York City, and it's become an issue with inflation around the country. And I think most folks would say that Trump and the Republicans haven't taken that seriously. So it'll be interesting to see. I think that'll change over the next few months as midterms come up at the end of this year. But the key thing for all of you as practice owners to think about is this affordability concern that's been talked about in the media has become a political issue. It may not impact the top 5 or 10% of earners, but it impacts a lot of pet owners. And when we think about veterinary industry growth, veterinary industry pricing, this affordability concept really plays into some of the industry dynamics. What we've seen is consistent negative invoice growth. So invoices have been down 2 to 3% a year for the last 15 quarters, going on basically 4 years. So 2022 to 2025, the industry has had declining invoices. I feel like as we've looked and studied the data, we kind of understand what's going on in the market. And here's our answer. And it's actually a pretty good answer because I think it'll keep pricing relatively high for a period of time. So there are a certain group of buyers who have proven to themselves over a number of years that they can execute post-closing and grow clinics at way better than the market, which is shrinking 2% on invoices. And so while industry fundamentals don't justify the valuation, we see sort of a tiering of buyers where thankfully there's a handful of confident buyers that are thinking that they can outperform the market post-closing, and they've proven it over a number of years, and that's driving their confidence in bidding things up. From the first half to the second half of 2025, multiples on general practices were essentially flat. We were at 12.5%, 12.5 times EBITDA in the first half of 25, 12.4 times EBITDA, so down 0.1 turns of EBITDA, nothing significant. And more importantly, over the last 2 months, we've signed 2 LOIs now at 16 times EBITDA or more. The corporate groups are realizing that aligning incentives with the doctors at the practice level by having the owner and or the associates stay owners in that particular location is becoming more popular. And almost 50% of the deals we did this year were joint ventures. The 2 key trends are, one, from 24 to 25, associate comp went up about 50 to 55%. And then the second graph down here on the bottom is, what is this as a percentage of the total transaction value? And so in 2025, about 4% of the total transaction went to associate DVMs, and that's up from 3.3% last year.
At VMX, I was asked whether or not there are any buyers for practices that have consistent negative invoice growth. What should we tell folks about that in case things aren't going swimmingly at their practices these days?
I think, and this is a hard one because as with everything, the answer depends. So if you've had consistent negative invoice growth and you're sitting in a small town in an old building, odds are there's not going to be a buyer for you. But if you're sitting in Charlotte or Atlanta or in the Chicago suburbs and you've got a nice building and you can't grow invoices, most buyers would say, this is an opportunity. Like, we have other practices in these areas and we are able to grow them. I think we can have confidence in our marketing ability and we can buy this and hopefully turn it around. And so I think negative invoice growth doesn't mean you can't sell a practice. It makes it harder. It will get you a lower multiple, and it's very geographic and building dependent.